We seem to have been given a challenge this morning where people were giving us the observation that there are cycles in markets and that prices can be higher and they can be lower. And stay tuned for the afternoon because one of our panels will answer that. I think he was figuring that that was going to be us. Smart forecasters will tell you a price and they'll tell you a time, but never associate the two of them. I think our one-liner is usually that prices will go up and down, but not necessarily in that order. We're going to try to be a little bit more precise about that, and I've asked my panelists here, which is a very distinguished group. Many of them have been here before, and they've dealt with this issue on a day-to-day basis for some number of years. What we have here in terms of this new reality, for me, is very simple. It's that the shale era has changed all the rules in oil markets, and it's changed the roles of the players. We've heard about the U.S. being a swing producer rather than Saudi Arabia. That's a pretty stark difference, and I didn't mention it at the time when it came up, but there's a bit of a problem with that because having thousands of independent decision makers coming to a mutually consistent decision is not only unlikely, it's illegal in the U.S., so that it's probably not going to happen that the shale will be the swing. So anyway, we are going to speak from this end to that end. I've given them 3 to 5 minutes. You'll see a couple of slides from a few of the panelists. And then we're going to throw some questions around between us, but we're leaving a fairly healthy amount of time for interaction between the panel and the audience. I think this is a topic which always seems to draw a lot of attention. We get a lot of very interesting differences of opinion there. But with that, I will let Haitham start.
Thank you, David. First of all, I'd like to thank Dr. Franson, Energy Intelligence, for organizing this event and inviting me to speak. I'm honored to be with this distinguished group of analysts. I'd like to start by just focusing on one item that I don't think we've spoken much about today, and that's China. I think if you see the graph I've just shown here, China has been the single most dominant factor affecting oil demand over the last 10, 15 years. And I think this is finally beginning to come to a halt and a slowdown in China, which is visible from these growth rates we see for Chinese GDP. I think the numbers, we used to see the double-digit numbers coming out of Chinese economy are no longer going to be there for the future, for the next 5, 10 years. And this, no doubt, has a significant effect on demand. We're seeing now a lot of exports coming out of China, especially for products that were mainly consumed internally. And that's mainly because of the slowdown that you see in Chinese industrial manufacturing sector and road transportation. So I think China is something definitely we'd like to keep a close eye on, or we should keep a close eye on going forward for the next period if we're going to try and find out where prices are heading. Of course, there's the other important element is the non-OPEC supply, and I mean, the graph is very clear in front of you. 2.4 million barrels a day growth in 2014, 2 to 2.4. And this is very clear. We heard this morning. We're no longer going to see these numbers in this year and next year. It's going to slow down even further. We're going to see at least 1 million barrels a day less from non-OPEC, going down even further into 2016 and 17, depending on how the prices continue to behave in the next coming months or year. So this is definitely another thing that we should keep a close eye on. The single most important factor for this huge growth in non-OPEC, of course, as you all know, was the U.S. production, shale, or the rise of unconventional oil in North America, not just the U.S., even Canada. And, you know, I mean, this is just a snapshot of this year. And, you know, we've all been following the rig count in the U.S. and how numbers for rigs have dropped significantly in the U.S. Yet, despite that, we saw the huge rise in production throughout the first half of the year up until July, August, when we finally started to see the red line slumping down, and now we're seeing significant reductions in U.S. production. I think this is definitely one of the main factors we're going to have to keep a close eye on going forward, and it's going to have a significant impact on oil prices and how they behave. Yet we have to be cautious, as most of the analysts before us spoke and said. You know, the fact is that they can quickly probably switch back on and come on and produce once prices are healthy again. Moving on to OPEC, the other major player, you know, we had the Secretary General here this morning and His Excellency was speaking about how OPEC's behavior is going to continue to be trying to balance the market. I think if you closely look at 2014, OPEC production was around 30 million. You see the rising trend in the yellow bars this year. We see a clear rise in OPEC production, and this is something that's expected to continue, we believe, because of rampant growth in Iraqi production. You're seeing an extra 150, 200,000 barrels a day coming out of Iraq over the last year or so. What Iran will do, we heard our colleagues from Iran a while ago talking about how much crude they're going to bring back onto the market. Countries like Kuwait, Saudi Arabia, UAE. The UAE oil minister yesterday was very clear and confirming that they're going to hit 3.5 million by 2017. So we're going to continue to see a rise in OPEC production in the coming couple of years. And this is something also that's going to have an effect on the market and the prices. And how that will coincide with how demand outlook is, it's unclear, but also with the potential slowdown we expect to see from non-OPEC. This is going to lead us, I think, for the next fourth quarter and the first half of next year into an area where we're going to have a lot of pressure on prices. So I'd like to just conclude by summing up. I think the direction is, or the outlook for the next 6 months to a year is not very positive in my view. I think amongst this panel, I'll probably call myself a bear. I'll declare myself a bear and take a more negative or pessimistic outlook on prices.
Thank you very much. I think those are four very key factors: the China growth, the non-OPEC production, and the need for the upstream. And you've sort of paralleled some of our panels this morning, and then ultimately what OPEC does also. And you think you're a bear. Here's our next speaker, Jeff Currie.
All right, what drives our bearish view? I want to start with the simple observation. It's not a coincidence we're sitting here today with the end of the commodity supercycle, not just oil, but what's happened across the commodity complex, the end of the weak dollar era. I mean, it's a strong dollar environment, and the rotation away from emerging markets back to developed markets, because all three of these themes are very much interrelated. And I would emphasize your view in oil cannot be taken independent of what's going on iron ore, the euro, pound sterling. You pick your financial instrument that's tied to either currencies or emerging markets or all the other commodities. You can't determine an equilibrium in one without having an equilibrium in the others. And to understand these themes that we see driving our bearish outlook on commodities, I want to emphasize the one we're the most bearish on right now is copper, not just oil. And the three themes, we call them the 3Ds of macro, and they're driving straight down the center of everything we're doing. And I want to emphasize these themes were a decade in the making. They're not something that's going to unwind over the next 6 months. It's going to take 5 years or more for them to resolve themselves going forward. So what are the three themes? We call them the 3Ds. The first one is deflation. So the first D is deflation. There again, a decade of high commodity prices has created excess capacity to produce all these commodities, whether it's oil, iron ore, LNG, coking coal, steel, pick your commodity. Every single one of them is overbuilt. And we argue that the commodity supercycle is alive and well. We're just in another phase of the commodity supercycle. We like to call the period during the 2000s as what we call the investment phase of the supercycle. We've now transitioned to what we call the exploitation phase of the supercycle. Another way to think about it, you spend $30 billion, 10 years, building a deep water offshore platform off the coast of Brazil, then it's up and running for the next 15 to 20 years, giving you a complete 30-year cycle. Because it's not a coincidence we're sitting here. We now have evidence of 3 supercycles in the post-war era. All of them are about 30 years apart because it's a supply cycle. We like to argue the super cycle is a supply cycle for commodities. The business cycle is a demand cycle. So first D, excess production capacity created a deflationary impulse around the world right now across your basic materials. So that's point one. Point two, this D is divergence. Divergence in growth of the U.S. against the rest of the world. Again, this is a story a decade in the making. If the U.S. hikes rates this December, which now the odds are it could get pushed out further, it'll be the first time in nearly a decade. And what this suggests is that the U.S. is far ahead of the rest of the world in accommodative monetary policy. In particular, we look at Europe. It didn't really pursue QE until 2012. China slowing down is just now beginning to do it. So what that means, you want to be long the US dollar. Even if it's an ugly contest between the US and the rest of the world, the US will win it, reinforcing a strong dollar environment. Now, what does this mean in terms of thinking about commodity cost structures? Now you have a devaluation of the Canadian dollar, Aussie dollar, Chilean peso. What does that do? Puts downward pressure on the cost structure. The cost structure is dropping like a brick across every one of these commodities. Now you think about combine that with the lower iron ore, steel, copper prices. What does that do to the cost of producing oil? Continues to deflate. So that's the second D. Let's go to the third D. The third D is deleveraging. Deleveraging of the emerging markets. You know, a decade of economic boom in the emerging markets created significant macro imbalances, particularly on the credit side. Now, we put this together. What it means is you have too much supply from deflation, lower cost structure from divergence. Deleveraging means you have lower demand for all of these commodities. Now, here's the kicker. It has a negative feedback loop. Think about this. Every time you have excess supply or deflation going on in steel, copper, and the rest of them, that puts downward pressure on the cost structure of oil. What do lower oil prices do to the U.S.? Stimulate growth. They still do because the U.S. is still short 4 million barrels a day of oil. It also leads to a stronger U.S. dollar. So we now have a stronger dollar, which then puts more downward pressure on the cost structure of the industry, which think about also what does the stronger dollar and higher interest rates in the U.S. do to the rest of the world? Exacerbate the deleveraging problem, reducing the demand for commodities. And so you can see it just feeds on of itself. I want to emphasize this is the exact opposite story that we were telling a decade ago. What was the core of Goldman's view a decade ago? Basically, short the dollar, long commodities, and long the bricks. What are we right now? We're long the dollar, short commodities, and short the bricks. The whole world has been turned upside down. And I like to just go back to thinking about what occurred and how did we go to $147 oil. We go back to, I could put, 2005, 2006. The world was really bearish, the United States. I was living here in the UK at the time, and I remember people were so bearish, the US, that, it was the rap star, 50 cents, had renamed himself 50 pence. Giselle, the supermodel, wouldn't take dollars anymore, only take euros. I think we forget how bearish the world was on the United States. What was driving that bearishness on the dollar? Huge current account as well as the twin deficits. And what was driving that current account? Oil. The United States was a net importer of 14 million barrels per day in 2006. We fast forward to July of 2008. Oil prices spiked to 147. I like to ask people, does anybody remember where the euro was trading that day? It actually went up to around 1.62. Never closed there, but it got up there. It was the weakest dollar print in the history of the United States. What is that telling you? The financial markets and the commodity markets were working together, hitting the Americans with a punch, get your act together, reduce your current account, and rebalance yourself. We fast forward today, between the shale revolution and weaker demand in the U.S., the U.S. has rebalanced itself, both in terms of credit growth, in terms of oil consumption. So the world has been turned upside down from where it was a decade ago. Who has all the problems? China has the problems, enormous amount of debt and credit imbalances, as well as the rest of the emerging market complex. Which is why if it took a decade for the United States to resolve the problems, it's going to take a long time for the emerging markets to resolve the problems. So you put it all together, it points to a lower for longer type of price environment with significant downward pressure on the cost structure. I'm going to leave it at that.
Perfect. The 3 Ds.
Yep.
You've got it. Spencer?
Thank you very much. Hard act to follow. I thought I would just make 2 points. One on the weakness of oil prices, and one on the potential importance of shale, not just in the next 3 or 6 months, but in terms of affecting the dynamics of the oil market over the next 5 or 10 years. How could shale change our world? So in terms of oil prices, I just want to make a simple point. It's perhaps an obvious point, but I go to particularly meetings with economists where this obvious point doesn't seem to be well understood. The weakness in oil prices is a supply story. Despite what you hear about a weakening global economy, despite what you hear about China slowing down, demand growth in 2014 grew by 0.8 million barrels a day, pretty much exactly in line with its 10-year average. And demand growth this year is set to grow in excess of 1.5 million barrels a day, so almost double its 10-year average. So demand has not been weak. Demand has either been growing at around trend last year or stronger than trend, significantly stronger than trend this year. Why have prices fallen? Because supply has been exceptionally strong. Supply growth grew by well over 2 million barrels a day last year and is set to grow by even more this year. Last year, the main driver of that was US shale. This year, the significant increase in OPEC production, with Iraq in particular doing about 1 million of that increase this year. You truly do not need a PhD in economics to work out when supply is growing by more than 2 million barrels a day and demand is growing by 1 million barrels a day, what will happen to prices, and that's what we've seen. Basic numbers, but I think very important. We're trying to understand the origin of this weakness, and in particular how it will pan out. It's very important to understand, as I say, this is a supply story, not a demand story. The second thing I wanted to think about was how does US shale, how could US shale affect oil, or the oil market and the behavior of the oil markets, not just over the next 3 to 6 months, but further out. And although shale, I think, obviously is a very small part of the oil market, accounts for less than 5% of total supply, the nature of its production characteristics and its financing characteristics means I think it could have a big impact on the way the oil market behaves. The most obvious one is the nature of shale operations, where there's obviously very short lead times between investment decisions and production, combined with very high decline rates, means that shale is far more responsive to short-run price movements than conventional oil operations. And we can see this already playing out in front of us with the charts, with dramatic falls off in number of rigs operating and dramatic falls off in the growth of US shale production. And this the greater responsiveness of shale to price sort of acts as a shock absorber for the rest of the oil market. Prices need to fall by less because more work is being done by supply. Or put another way, the introduction of this US shale has introduced a kink in the supply curve, if you like, which should act to dampen price volatility going forward. So going forward, other things equal, the market should be prices should be less volatile going forward because you've got this component of supply which is far more price responsive. That's the sort of the good news in terms of volatility. The bad news is that shale producers are far more dependent on credit. Independent producers in the lower 48, their balance sheets are a lot smaller, they're a lot weaker, they're a lot more highly geared, and the vast majority of those independents have a business model which at the moment is relying on negative cash flows, so they rely on continuous flows of credit to continue to be able to invest and to continue to be able to produce. And as such, US shale producers are far more exposed to the vagaries of banking and the financial system. In my previous life, I used to work, I was chief economist for the Bank of England through the financial crisis, and we learnt through our own painful experience just how important those credit channels can be in amplifying economic volatility. So you have a shock, but that shock can be greatly amplified by the impact of the banking system, the weakness in the banking system. Up till now, the oil market has been essentially insulated from those credit channels because of the nature of the main players have either been national oil companies or international oil companies. The nature of small producers mean the oil market is exposed to financial shocks in a way it hasn't been exposed to up to now. I guess the third feature I wanted to... So there are two different features about shale. The third one is the nature of the production process, where US shale is a manufacturing type process. It repeating similar processes with similar equipment in similar locations again and again and again. And a key feature we know about manufacturing from around the world across all sectors of the economy is manufacturing processes tend to generate far greater increases in productivity than many other types of processes. And we can see that, and that's true for US shale, where productivity gains in US shale over the last 7 years have averaged over 30% a year, each year for the last 7 years, if you measure productivity in terms of initial production per rig. So these are unbelievably mind-boggling productivity gains. And I think a key question is whether some of those manufacturing-type processes that we've seen being developed in shale, in terms of standardization, repeated processes, can then be applied across to other parts of the oil industry. So, although small, I think the nature of US shale is very different in terms of its responsiveness to price, its exposure to financial shocks, and also the nature of its production process and the productivity gains. And I think those three things together, I think, have big implications for the oil market going forward.
Thank you very much, Spencer. So he's added a couple of pieces to the puzzle, and we've gone very much from the macro, from the super cycle, to the micro in terms of process and productivity gains. And certainly the financial side of U.S. shale is quite important. And we've had a bit of a milestone getting past the end of September without too many difficulties. There are some bankruptcies that have gone on, but clearly financial parameters are a critical feature, and thank you for adding that. Antonio Merino is our last speaker. I should say Spencer is the chief economist of BP, as he mentioned, and Pedro is the chief economist of Repsol, so we have two represent that industry, and Haitham is with KPC, and then we have the random Wall Street guy, which I'm of the same community in a way. And I think that's a nice way to get a difference of opinions and a difference of viewpoints on what's going on with oil prices. Thank you. Our anchor man.
Okay, thank you, David. First, I want to thank the organizers, especially Herman and David, for inviting me, although I know that in the case of David, it's a trap, because he was looking for a less bearish, or, less bearish, I'm not going to say
less bearish,
less bearish analyst in the community, and he came to the conclusion that I'm one of these. And I'm going to tell you, I am, because I think the drivers of the market, independently of the length of the commodity cycle, means that the cycle has to be sustainable. And this cycle, in my view, is not sustainable at the prices that we are setting. So I'm not able to manage the English as Jeff, but I decided to use the letters. So I go for S. He went for D, deflation, you'd say divergence, and the leverage. And just from scratch, I have 4. And all of them are S. A slower response of the Fed to the expected lifting of interest rates. Why so? Because we are in a deflation. All of us are in a deflation. We have the lower expectation for inflation in the US since 2000 and I don't remember. What does it mean? That whatever you see in the screens, the Fed is going to be quite prudent when deciding about lifting interest rates. This is actually discounted this week in the market. I know that this is short term, but this is one S. I need to go through the screens to go for another S. The S is stronger demand response than expected and stronger demand response than seen in the forecast, because anything that is done with oil has to take into account that the figures come with even 3 months of delay. I was just mentioning, Jeff, that the elasticity that they have in their own calculation is that $5 at the same growth of the global economy will imply like 500,000 more barrels of oil demand per year. So I have a graph which says the following. On average, till the last cycle, what we have is demand was growing at a pace of about 1.8. And during the last cycle, 2004, it is growing at a pace of 1%. What I'm saying is elasticity, price elasticity is about 0.2, between 0.15 and 0.20. So people tend to think that because prices are now going down, demand is growing. But next year, if prices stabilize, demand is not going to grow as fast as it was growing this year. This is not true. I mean, you can have $60 price, and the global economy is growing at 5%, and you will have 2% growth in demand. You can have 4% growth in global growth, okay? And then the prices go to 100%, and global demand is not going to grow 2%, it's going to grow 1%. What I'm saying is, if we keep between $50 and $60 per barrel, what we are going to have is an incremental demand of more than 1 and 2 million barrels per day. I know we are forecasting, so this is a range. This is the middle of the range. What we had now, the International Energy is forecasting 1.8, last forecast. They should come with a new forecast next week. I know that Adam is here and they have a lower forecast. But still, India, China, Europe, except Germany in the last couple of months, all the countries are increasing demand, although the growth is not as it was. Even China, even Thailand, all the countries, even if they slow down growth, they will continue consuming more oil. Stronger supply response. It is true, this is a commodity cycle, but as Jeff said, it has to come with a dollar cycle. The dollar has always, in the long run, depreciated. I don't know why. I can tell you, I have my own ideas. But even if now it's appreciating, it's going to be temporary. And we don't know what is going to happen in the next couple of years. But let's think that now capital is going out from emerging countries because this is a cycle. But the supply response in oil is different from other commodities because we have depletion. Okay? The question is, when you talk about shale, you say shale is different. We are seeing that shale production is going down. As you can see, I'm not as bearish as you can imagine. I mean, I'm trying to make an argument that it's not only shale. It's international oil companies are producing less oil. The question is, you have to go very carefully through the data. On a monthly basis, this is what the International Energy Agency has in its database. Since December, oil, non-OPEC supply has decreased by 1.3 million barrels per day. I don't think this figure, it can be changed. But more or less, this is distributed in the following way. Most of what we see is that non-OPEC supply is just slowing down because of the increase in biofuels, because of the legal obligation to use bioethanol and others. But actually, if you look at real crude production, is going down in all the countries, in the US, in Canada, in Kazakhstan, well, in Yemen, as you can imagine, in Mexico, in Norway, in Brazil, in UK, in Colombia, in China. This is the depletion in areas which are, in a sense, shale, but in other sense, it's not shale. Secondly, supply response is stronger than we are thinking, because when you compare this with the past cycle during 2008, 2009, you can see it's in the, I always, the big, the small graph in black, you can see the response in the 2008, 2009 to the fall in prices was production, non-OPEC production increased a little bit, and it was complemented with biofuels. What we have now is, since December, we have a drop in non-OPEC production, all included, and a bigger drop in non-OPEC supply when you take out biofuels. This is true that we are talking about the drivers. We are talking about short-term movements which should take into account another thing, which is sustainability. It is sustainable for OPEC to continue increasing its production when the deficit of OPEC countries is what we are seeing, and when the number of rigs in OPEC countries going down. I don't think OPEC can, in a sustainable manner, increase production. So sustainability is the last S I'm going to use. So I don't think they can increase. The big question mark is, during this last year, Iraq and Saudi Arabia increased by approximately 2 million barrels per day, and that creates a lot of excess supply in the market. But I don't think it's sustainable to have those countries increasing supply next and the following years. But the big sustainability for international oil companies is this graph. And I finished. Organic CapEx as a percentage of operating cash flow is unsustainable. Either you cut CapEx even farther than what Fatih was saying this morning, or prices has to go up because it's unsustainable. This is why, although we recognize that we are in a commodity cycle and the big issues are China, a strengthening dollar, we tend to think that the nature of the business, the declining nature of the oil production, plus the demand response to lower prices will rebalance the market a little bit sooner than consensus.
Thank you. You put 5 economists up on the front, and they put some letters down, and they turn out to be S and D. That figures. It's all about supply and demand. But our panel is about P. It's about prices. And what I'm going to do is I'm going to ask the panelists, I'll give them a couple of ranges, and we can then take a small poll about where prices will be. And when I say oil prices, let's make it real. We'll do Brent, because WTI isn't very real with all of the side effects on it and things like that. And this is for the end of the year. I'll put a time on it as well. It's one of the unwritten rules that I'm violating here. That we'll put a time and a price. So between now and the end, December 31st, will prices bottom out in a range that's in the $20 to $40 range? And will prices top out over that same period in a range between $40 and $60 a barrel? Do you understand the question? Can you explain it to me? We could actually ask the whole audience, but I'm just going to keep it to these guys. Haitham, where would you be on it?
This was the one question I was hoping you wouldn't ask, but I guess it's one of the toughest things to try to forecast. But I mean, based on the explanation I tried to give and what my colleagues here tried to demonstrate, I think we're definitely in for a cycle or a period towards the end of the year and probably into the first half of next year of what I think is going to be low oil prices. And defining low oil prices is anybody's guess, but I think we're going to be probably in the $40 to $60 range for Brent.
Okay, Jeff?
I'm on the downside on that one. Definitely in that 20 to 40 camp. Yeah, in terms of, I want to emphasize, we never forecasted $200 oil. We have never forecasted $20 oil. Our baseline forecast is for 45 with a trough of 38 during the autumn. And what's driving that trough and what was the genesis of our $20 scenario? It's essentially blowing out storage capacity. Now, what do I mean by that? An easy way to understand this, let's take metals. Energy is very different. It's the only one you can actually do this in. Because with metals, if you produce a metric ton of aluminum, you can put it outside the smelter. Oil, if you produce a barrel of oil, can you put it outside the well? No, it just go into the ground. And because of that, we think about metals. All you need to store it is a parking lot, a chain link fence, maybe a guard dog for security. You can stack the stuff to the moon. Energy, it has to go into that pipeline and go into that storage facility. So once you breach that storage capacity, you break the storage arb, and spot prices can collapse down to cash costs. We put cash costs at somewhere around $20 a barrel for U.S. producers. However, one thing I'm very convinced of, and Spencer hit on this point, is even if you go to $20 a barrel, it does not change anybody's perspective. I don't think anybody in this room saw 20, they would actually get that panicky. It doesn't change the access to capital to this market. You need to have a capitulation moment at some point in time so people quit giving this industry money. We saw that 160% reinvestment rate. And it's not so much the companies. The companies will keep spending that kind of money as long as somebody's out there to give it. And I think that's really the key here is reason why we take that lower for longer, because if the price pops up to that $60 a barrel range, we saw what happens. All the rigs go back to work and you're back to the same problem again. You got to shut those capital markets down. And it's not the oil price that needs to do it. It's everybody's expectations on the oil price.
Thank you. Spencer?
So my understanding of the oil market is an oil market which is massively oversupplied. Unless something acts to reduce that supply very dramatically, that will take a while for that oversupply to wear off. And so I can't see any strong reason why prices should increase over the sort of time period that you're talking about. Likewise, it's not obvious to me why they should fall very dramatically from here. I guess I make a plea, though. I think we should become less obsessed about the oil price. I don't think it's a very meaningful statistic. In my old job, I used to go around many different businesses, and I go to a car company, and a car company would never say to me, Spencer, what's the price of a car going to be in 10 years' time? I'm thinking about doing some investment. Can you tell me the price of a car? And I'll work out if I want to build a new car or not. They wouldn't do that. Mm-hmm. What they would do is work out, can I produce a car more efficiently and more effectively than anybody else? And so can I make a margin? In which case, then I'll go out and invest. And likewise, if the oil price is high because somebody slapped a big carbon price on it, that's very different to if the oil price is high because supply is weakened very dramatically, or if the oil price is high because demand is very strong. And so therefore I think we should become when every time anybody asks you a question about what do you think will happen if oil prices were 60 or 100, I think you should immediately ask the question back was, well, why are they 60 or 100? What's the underlying factor? And then we can have a discussion about it rather than just being obsessed about the oil price.
So we'll put you down on the 20 to 40?
No, I think more than 40 to 60.
Okay, so 40 to 60, 40 to 60, 20 to 40, and we know where you are. So I'm going to skip to me, and I'm at 20 to 40. So 20 to 40, no, you get to vote too. So
Well, I think
it's
I
gonna-
think
3 to 2 for the
40
bigger.
40 to 60 is.
Okay.
And it is true that now you have a low refining demand, and also that for rebalancing the market, you will need to rid of a lot of the overhang that you have in inventories. But there is one thing that works in this market is expectations. Probably if you have the spot market overreacting because nobody believes that the adjustment is taking place, and sooner than later, you have an adjustment between supply and demand, but also you have a lot of inventories, probably what you're going to see is that the market is going to move probably to backwardation. And then you cannot hedge, you cannot finance the increased production because the only thing that you can do is produce at this price. Mm-hmm. In that case, the reaction to the $60 that we saw in terms of increasing rigs in the US should not take place. So there are things that can move a little bit differently and which can justify this range for the end of the year.
Okay. How about the audience? How many are in the $20 to $40 range at the end of this year? The guy that knocked me off my chair says yes. There's one guy, 1, 2, 3, 4. How about 40 to 60? Boom. Okay, so we know where the sense of the audience is. I had a call with one of our industry clients, and they said, and what about on the next cycle? Where's it going to go? And I said, I don't see it getting much higher than 55. And she said, 75? And I said, no, 55. She said, oh, good, 75. So you understand why people like certain numbers and don't like other numbers. We have about 25 minutes. Actually, we have 23 minutes and 3 seconds. And I'm going to throw it open to the audience again. Raise your hand, wait for a microphone, identify yourself, and make your question reasonably terse. If you want to direct it to one of the panel, you may. If it's a more general question, I may assign it or I may take it myself. There's got to be some hands out there. It's this, there we, in the back here. Here she comes.
Hello, Thomas Plicard, Vivid Economics. I have a question which follows on from Spencer's previous boss. He talked about unburnable carbon not too long ago. And how will binding carbon targets affect these cycles that we discussed about today? Because you're looking a year into the future, but what if we look 5 years into the future and we see some outcome in Paris? How will that affect these estimations that we're working with right now?
We're looking 2 months into the future, I think. Yeah, and I think that's a good question. I'll ask for them to say something about it, but it's my own personal view that if it wasn't for Paris and the preamble and the side meetings and things that have gone on, I think there would maybe be less volatility in the market. There would be a different set of things on the mind of, say, major oil producers that are looking at their resource and wondering what it's going to be worth post-Paris or post whenever you get a real environmental impact on oil prices, where your rents are now going into carbon taxes and other things. Some interesting and important questions. And Haitham, do you have any thoughts on that? Or?
Well, I mean, this is a question that was touched upon this morning, and I think in one of the audience asked the OPEC Secretary General about why only 2 members from OPEC had agreed to sign up to this agreement. And I think, like you said, David, I mean, in this part of the world, in the Middle East, I think there's an abundance of resources, and the producers there are actually just looking at how they can take profit from these resources rather than focus on issues like carbon tax and things like this that are more looked at in the Western world and in the United States. So I think we're still, in our part of the world, not focused yet on these kind of taxes and carbon tax issues.
Okay. Beyond petroleum.
So in BP's Energy Outlook 2035, we looked at what we thought based on current policies, and this was done early in the year, so before many of the people had launched their NIDCs, based on our view about how current policies and how those policies were likely to evolve. That led to a world where carbon emissions over the next 20-odd years would be rising by around 25% or so. So significantly greater than the sort of 40% reductions in carbon emissions that the G7 have asked for in their communique. And so the message from the Energy Outlook was more needs to be done in terms of carbon emissions. And I think that's entirely consistent with the letter that Bob Dudley has, for BP signed along with a number of other oil companies, suggesting that BP wanted to be a part of responding to that challenge, and making the point that a key component of when you think about how to respond to that is the emphasis on governments trying to find a way of sort of achieving a meaningful global price for carbon. Because a meaningful global price for carbon is by far and away the most efficient way in which one can try and tackle this. I guess I'll make two other points. There's a number of different scenarios. The IEA has one scenario. Many other people have different, similar scenarios where they say, what could the world look like if we were to achieve an outcome where the carbon emissions had been reduced by around 40% to their current levels? And there's two key features of that. One is a vast majority of the work that is done when you're trying to reduce carbon emissions is not done by the fuel mix. It's not done by moving away from fossil fuels into non-fossil fuels. It's done by energy efficiency. It's by growing economies in a way which they need less and less energy to grow those economies. And I find it extraordinarily annoying and extraordinarily frustrating that whenever we have a discussion about carbon emissions, people almost immediately go to the fuel mix and ignore this huge importance of energy efficiency. And I think that's sort of number one point. Number two is in nearly all of in those scenarios, and there's many, the IEA being just one of them, in which do achieve that reduction in carbon emissions of 40%. Fossil fuels account for around 2/3 of the world's energy by 2035, 2040, consistent with that. So the idea that somehow this means the end of fossil fuels just doesn't add up in terms of the numbers. Fossil fuels will still be, in those scenarios, the dominant fuel, even in a world where carbon prices in one form or another are raised sufficiently to achieve that reduction in carbon emissions.
I know my other two speakers really want to answer this, so I'm not going to let them. Question over in the back there.
Andy Critchlow from the Telegraph.
Yes.
My point is really to you, Jeff Currie. You mentioned that oil prices hit $147 a barrel in 2008, and I think you made reference to that, to the dollar, the level of the dollar at the time. Well, actually, the reason why they hit $147 a barrel in 2008 was because there was a report that an oil platform in the Gulf Romanian oil platform had been seized by the Iranian Republican Guard. Now, the reason why I mention that is because that was political risk. And anyone who was reporting oil at that time, the question that they were putting to the Secretary General of OPEC, to the President of OPEC, and ministers in the region was political risk. You know, what is the value of political risk per barrel? The answer that I got at that time was about $40, $50 a barrel was wrapped up in the fear that there may be some disruption to supply. What I don't get at the moment, and what we haven't really addressed on the panel today, is where has the political risk gone? Because if I look at the Middle East at the moment, it's a car crash. You've got Russian jets bombing people, who knows who, in Syria. You've got boots on the ground, Russian boots on the ground in Syria. You've got a third of Iraq under the occupation of a terrorist organization. You've got a full-blown war on the borders of Saudi Arabia. It seems to me that about 17 million barrels of physical supply, it could be shut off in a heartbeat. But we've got oil trading at $50 a barrel. Does political risk premium no longer exist in the oil price, or are we just ignoring it?
No, that's a very good point, and it's something that we've been saying. Isn't it interesting that there has never been, and we agree with you, a higher level of geopolitical risk in the Middle East, and yet it's also producing a record amount of oil. And it's not just the Middle East. I mean, as we've talked about, the surplus in inventory, the surplus in daily flows, which we rate between 2 and 3 million barrels a day, that gives a comfort level so that geopolitics doesn't matter as much, but it certainly hasn't gone away. And Antonio, why don't you go at that, and then we'll let Jeff try. So,
Well, probably the reaction of the market this day has something to do with this increased perception of geopolitical risks. But the question is, as Jeff said, that we are in a different moment in the whole picture. Most markers are bearish because they tend to think that one engine of the global growth is not working. But they have doubt if the plane can fly on one engine. And lately in August, we thought, well, there are markets or countries in East Asia which are like Southern European countries during 2008, 2012, sorry, 26, 2008, that they are living on a lot of debt, and their currency has appreciated a lot, and they have to go through a process of constriction or a process of rebalancing their disequilibrium. But no one thought about the renminbi or the yen or the yuan depreciating, and the danger that can have for the whole economy if it continues depreciating. In that scenario, what you have is macroeconomic concern force the price down. Secondly, you have a lot of inventory overhang, maximum production in OPEC. And I think, as I told you before, markets are very short-termist in the sense that they are looking at what is going on, but they cannot have a real picture of what can happen in 6 months' time. For example, in terms of geopolitical risks. I mean, no one expected to have the geopolitical risk that we are having nowadays, probably even 3 months ago, when we were saying the opposite. We were saying that an agreement has been signed with Iran, a lot of Iranian crude is going to come to the market. So the change in the perception of the geopolitical risk probably has taken place only in the last couple of weeks, although it was there and implicitly was there since, as you said, Iraq was in the midst of I would say, a lack of control of some part of the territory. It is not till this week that we can say that those risks are hidden in the market views.
Jeff?
Well, I want to start. I don't know any investors who trade oil with political risks in mind. It just doesn't pay, and it has a negative carry. It's too difficult of a trade to put on. And then the evidence, when we went to 147, if there was really a $40 to $50 a barrel political premium in it, we would have seen these companies printing ROEs like we have never seen before. They weren't. In fact, the max ROE in this sector was achieved in 2005, 2006, before costs eroded all. So there's no evidence we had any significant political premium embedded in prices when we reached those higher levels. But in terms of thinking about the current environment, the way I'd describe it is geopolitical risk has never been higher, but oil at risk has never been lower. Why do I say that? You've lost Libya. Nigeria has been beaten in terms of overall production capacity going back to 2004. Venezuela is a fraction of what it used to be. You have Iran, has the sanctions off. You look at the places where you're getting the growth, which is primarily Saudi Arabia and Iraq. They're very secure. You point out, let's say, Basra and the JVs down there. These are JVs. This is not the Iraqi oil company doing it. I've talked to CEOs of companies putting billions of dollars of work there. Go, I'm not putting a dime in that country until I can go to sleep and wake up every morning knowing that my oil made it to port. So I just don't see the oil that's currently producing at the same risk what we have seen historically. In fact, if anything, we'd argue the risk of getting more oil as opposed to less oil, more from Iran, more from Libya. You even have the neutral zone off in Saudi Arabia and Kuwait. So it all spells risk to more supply as to risk to less supply.
As my colleague Axel Bush is wont to say, it's just a question of headline fatigue. We didn't even, we didn't even mention Ukraine. Has that all been solved? Not even close. It's still as bad as it ever was. Putin is getting a bit more effrontery, but we've read about that so often and so much, oh yeah, we know about that, so we don't pay much attention. Yeah, Haitham.
Yeah, I'd like to comment on this. It's a very good question, but I think every time we see oil prices go up and there's sometimes no real explanation for it, the easiest thing is to blame it on geopolitics. And like my colleague said, there's so many of this stuff that's ongoing for years. Like how long has Syria been in this crisis? 5 years, 6 years now? Libyan oil has been out for how long? And the stuff that's going on in Libya. Yemen and what's happening in Yemen has been going on for a while, except for the Saudi intervention militarily a few recent while ago. The Middle East is, in particular, has always been a very hot spot on the political front. And yet, as my colleague said, oil has continued to flow, gas has continued to flow without any interruption. If anything, I think the geopolitical front is less tense, especially with the situation with Iran and the agreement now on the nuclear agreement with the West. So I think that was one of the main factors that everybody was wary of, what would happen with Iran, would Israel strike the Iranian reactors. And so I think a lot of that, it's hard to quantify how much of a risk premium or geopolitical risk premium can be inserted into the price.
Thank you.
Today, a lot of these events, like I said, have been going on for so many years. And I think the market reacts psychologically for $4 or $5 immediately when something new happens, and then it's factored in. And I think a lot of these issues have basically now been factored into the price today.
It used to be the speculators did it, but that's geopolitics is good too. A couple more questions. Yes, all the way in the back.
Yes, my name is Jamil Laston. I'm from Currie, in the Caribbean. I'm more downstream, so I'm trying to take a side step and ask maybe a weird question. Do you guys think at some point, because we are seeing it, there's a huge demand for storage right now, that at some point the storage will also be of impact on the price? I can imagine that you can keep on producing, but if you don't have storage capacity, that can also impact. Can you maybe comment on that?
Okay. That's something that we talked about as a possibility back as long ago as April, where maybe Cushing is going to be flowing over the top or whatever. And we've had a lot of internal debates about it. And it's pretty easy to build on-land tanks. You just put some sides on it, you put a top on it. There's always a lot of boats. So what if they have a single hull? We're just putting oil in it, and we'll do it quietly and hide it someplace. So it hasn't been. We haven't hit the storage wall, if you will. If somebody has a different view on that, where they think there's a legitimate possibility of us running out of storage, anybody? Jeff?
Jeff's already said,
Yeah.
and I'll...
Your turn, that's right, it's your turn.
I think, well, Jeff highlighted this point, and I just think I'd echo the same sort of qualitative...
Yeah, just so we put it some numbers,
Yeah.
we put it 375 million barrels of excess capacity. How much of that's usable is a question mark, which means you could make it a year running a million barrel per day surplus. We put the surplus at 2, but you chop that down to 6 months, which makes it difficult to get through the spring.
Okay. So it's a risk.
And it's a material risk. I mean, the additional cost associated with floating versus onshore storage means if that happens,
Right.
it's a material downside risk.
Yeah, and what's going to happen, of course, is if you start actively bidding for space in tankers, that the freight rates are going to go up. And depending how it affects the forward price curve, your incentive to hold it may start to go down. And all of a sudden you get this next tranche of oil. We say, once you've solved the daily balance problem, then you got to get rid of the surplus that's there. And if it's a price increase, maybe you've got this other set of reserves called U.S. shale that comes back into the market. There was another question I saw somewhere. There it is. Luis.
You said you are in the camp of 40 to 20. I'd like to narrow you down. Are you in the camp of 40 or 20? That's my first question.
35 Brent.
Okay.
Actually, it's 40 Brent and 35
in the fall of
WTI.
prices that we have seen, sustained fall of prices, a couple of times we saw a slight hint of contango. If prices continue to fall, do you have any feeling for at what moment we could get a shift to contango? And last question is different. And do you have any opinion of what we may see, especially depending on how the actors feel in the first week of December meeting of OPEC?
Okay, I think we're not supposed to ask the guy in the end that question, but anybody else has views on the OPEC meeting and what was the other one? Was Contango. We're in Contango. The question is, an interesting question that we're dealing with is as the crude surplus gets shoved through the refinery and is showing up now as more of a product surplus, when do you get a contango in product markets? And when do you get maybe some demand pressure, some downward demand pressure because of rising prices, or downward pressure because of increasing inventory? So the product markets may come back in and feed back on crude, because this is a two-way flow in terms of pricing power. But OPEC meeting.
Before I talk about the OPEC meeting, I'd just like to add a point on this. As you said, the market's in contango, and this is clearly evidenced by the fact that there's more demand for floating storage than traditionally. This is when people start to store on ships, when they feel that storage onshore is close to capacity. And this is supported by the forward curve, where they can justify the cost of keeping the ships in store. And the industry has been very smart in how they can deal with these issues, bottlenecks everywhere, or potentially having like the Cushing situation that was expected to happen back in April, May. So I think, for the contango, we're going to expect to see this for a while. There's such a huge oversupply in the market, close as 2 million barrels a day. You see this very clearly in the Dubai structure. Dubai structure was in backwardation briefly last month, but that was because of something happening on the Dubai partials between a couple of players. And then as soon as that activity stopped, you saw the structure flip into clear contango, which is a sign of the oversupply. As far as the OPEC meeting, I'm not here representing OPEC, so I can't really talk about what they might do or they might not do. But I would say my personal opinion is I expect that there will be a continuation of the same strategy, the same policy that's been adopted over the last year. This is my personal view.
When you talk about floating storage, let's remember where a lot of these cargoes are coming from. It's a lot cheaper to have your Nigerian cargo on the water than on shore in Nigeria, possibly. So, did anybody want to react to that? The question? Oh, here's one. Ian?
Hi, yeah, Ian from Argus. I think Spencer was on point when he talked about the obsession with the crude price. What really matters is returns and margins. And one of the interesting things about the lower oil price this year is that during a lot of the time when the crude price was pretty low, actually product prices were strong, and refining margins for the clean products were very good. I just wonder whether members of the panel can explain why refining margins have held up so strongly, and if that ends, what would the impact be on the crude price, the feedback that you mentioned, David, and how they see that relationship between products and crude panning out?
I think Antonio and then Haitham are both, I think, equipped to answer that. You've done a lot of work in the downstream, I know, right? So, yeah.
Well,
both of you. Not at the same time.
I tend to think that when demand from the refining industry and from the final consumer is there, normally refining margins stay high. But there are two considerations. One consideration is that when you see the drop in oil prices and you see the change in global demand, it was 700,000 barrels per day of incremental demand last year. So probably the inventories, the product inventories were quite low compared to the level of inventories in the crude at the beginning of the year. So before the drop in prices, crude inventories were higher than average, and products were lower than average. There are two other things which can be considered, and one thing is that high conversion is the explanation for the margins. And high conversion sometimes has to do with the profitability, with the margins in, between light crude and heavy crudes. And when you see the slate of crude being produced, when you have 2 more million barrels coming from OPEC, on average, this is heavier than having 2 more million barrels from shale. So it could help to explain partially why the margins are where they are. But going forward, there are two things. One is the level of inventories in terms of products, and also the final demand. Well, supply and it's also an issue because you have more refining coming from new refineries. But it's also very relevant to keep an eye on what's happened to demand. We know that now we are entering the winter, but still, when you see the numbers, it seems that the demand continue compared to last year, even compared to any year during the last 10 years, still is higher. The only thing that can derail this is you think that the global economy is zero. This is the bomb. This is what you were expecting, 0, 0, 0. Is that the global demand falter a lot. But
we had another question over there, but we're out of time. So, Peter, I will give it back to you. And anybody that wants to ask a question of one of the panelists will hang around a little bit on the side. Thank you very much. And please join me in thanking our speakers.